Now, whatever one may think about Keynesianism in the field of economics, essentially calling for government expenditures to stimulate demand in economies performing below their capacity, whatever you think about that, the great British economy, John Maynard Keynes, was little short of brilliant in his analysis of the investment world. Keynes recognized this critical distinction between economics and emotions way back in 1925. Observing the predilection of investors to implicitly assume that the future will resemble the past, Keynes warned, quote, "It is dangerous to apply to the future inductive arguments based on past experience unless we distinguish the broad reasons for what past experience was." A decade later, in his amazing general theory of employment, interest, and money, Keynes focused on two broad reasons that explain the returns on stocks. The first was what he called enterprise, forecasting the prospective yield of an asset over its entire life, cash flow, if you will. The second was speculation, forecasting the psychology of the market. Together, these two factors explain what he called the state of long-term expectations for an investment, which is the title of Chapter 12 of his General Theory book. From his vantage point in London, all those years ago, Keynes observed that in one of the greatest investment markets in the world, namely New York, the influence of speculation is enormous. It is rare for an American to invest for income, and he will not readily purchase an investment except in the hope of capital appreciation. This is only another way of saying that he's attaching his hopes to a favorable change in the conventional basis of valuation, i.e., that he is a speculator, end of Keynes' quote. Today, 75 years after he wrote those words, the same situation prevails, except that it's worse. Keynes' conviction that speculation would dominate enterprise in the financial markets was based on his belief that individuals, who were then the dominant force, of course, in the market, were largely ignorant of business operations and lacking in financial savvy, and thus prone to betting on how other investors might value their stocks in the short term. Keynes called it a beauty contest, but not a contest to pick the most beautiful woman, but a contest to pick the woman whom other voters chose to be the most beautiful. That's Keynes' famous beauty contest analysis. And it sounds just like the stock market, and of course it is. This second derivative, so-called gambling mentality, leads to excessive, even absurd, short-term fluctuations. We've seen them many times this year already, based on investors' response to events of ephemeral or insignificant character. Short-term fluctuations, even expected fluctuations, in the earnings of stocks of business firms, he argued correctly, would lead to unreasoning waves of optimistic and pessimistic sentiment. Now, Keynes conceded that competition between expert professionals possessing judgment and knowledge beyond that of the average private investor should correct, the vagaries caused by these ignorant individuals. But he didn't. He predicted, in fact, that the energies and skills of the professional investor would also come to be largely concerned not with making superior long-term forecasts of the probable yield of investment over a whole life, but with foreseeing changes in the conventional basis of valuation a short time ahead of the general public. He therefore described the market, as I'm quoting here, a battle of wits, to anticipate the basis of conventional valuation a few months hence, rather than the prospective yield of an investment over a long term of years. Now, an interesting sideline. In my 1951 Princeton senior thesis on the mutual fund industry, I cited Keynes' conclusions, those very words I just read you, and had the temerity to disagree with the great man. Rather than professional investors succumbing to the speculative psychology of ignorant market participation, I argued in that thesis that these experienced pros would focus on enterprise, in what I predicted, accurately to say the least as it turned out, would become a far larger mutual fund industry. Our portfolio managers would, I'm embarrassed to read you this quote, supply the market with the demand for securities that is steady, sophisticated, enlightened, and analytic. The market demand that is steady from these institutional investors, sophisticated, enlightened, and analytic. A demand that is based essentially on the intrinsic performance of the corporation, quoting still from my thesis, rather than the public appraisal reflected in the price of its shares, end quote. My. Alas, The sophisticated and analytical focus on enterprise that I predicted from the mutual fund industry's expert professionals has utterly failed to materialize. It's practically vanished. In fact, the emphasis on speculation by mutual funds has increased many times over. Score. Keynes 1, Bogle nothing. Sounds like a World Series game, doesn't it? I think it's actually Keynes 82, Bogle nothing. Interestingly, Keynes was well aware of the fallibility of forecasting stock returns, noting that it would be foolish in forming our expectations to attach great weights to matters which are very uncertain. He added, by very uncertain, I do not mean the same thing as improbable. While Keynes made no attempt to quantify these relationships between enterprise and speculation in shaping market returns, however, it occurred to me decades later to do exactly that, and that is what I will talk about now. By the late 1980s, based on my own first-hand experience and my research in the financial markets, I concluded that there were two essential sources of equity returns. One was economics, and two was emotions. What Keynes had described as enterprise, I called economics. What Keynes termed speculation, I find well defined by emotions. The former, economics, I defined as investment return. It's as simple as the initial dividend yield on stocks plus the subsequent rate of earnings growth. Later, I defined by the latter, speculative return, the change in the price investors are willing to pay for each dollar of earnings, essentially the PE ratio. The returns generated by changes in valuations or the discount rate that investors place on future corporate earnings. Now, it's as simple as this. Add speculative returns to investment returns, and there you get the total returns generated by the stock market. For example, let's assume stocks begin a decade. You won't have any trouble with this math, I don't think. With a dividend yield of 4.5% and experience subsequent earnings growth of 4.5%, the investment return would be 9%. And if investors are willing to pay, let's say, $15 for each dollar of earnings, PE ratio, at the beginning of the decade, and $20 at its conclusion, that 33% spread over a decade would translate into an additional speculative return of about 3% per year. Simply combining those two returns, investment and speculative together, the total return on stocks would be 9 plus 3, or 12%. It's not very complicated. This remarkably simple numeric approach of separating enterprise and speculation has in fact been borne out in practice. So again, I think I'm going to win this time. I have the temerity to suggest that Lord Keynes would respect this mathematical extension of his concept. Decade after decade, over the past century, we can account with remarkable precision for the total return actually earned by common stocks. Let's look at the record a second. The investment return on stocks has proven to be more reasonably susceptible to reasonable expectations, remarkably susceptible to reasonable expectations. The initial dividend yield, a crucial but today underrated factor in shaping stock returns, is known at the moment you invest. The steady contribution of dividend yields to investment return during every decade over the past century has always, of course, been positive. You can't have a negative dividend, and only once outside the range of 3 to 5%. That yield, by the way, was 1%, the exception when the year 2000 began, a red flag that nobody seemed to heed and should have. The long-term rate of earnings growth, on the other hand, while hardly given to that same kind of precision, is relatively stable. The fact is that corporate earnings grow at the rate of America. They have historically grown at about 5% in nominal terms, about the same growth rate as our economy. Earnings have rarely represented less than 4% of our annual GDP, gross domestic product, nor more than 8%. It's a very narrow channel. And with the exception of the depression-ridden 30s, the contribution of earnings growth was positive in every decade in the last century, usually composing 4 to 7% of total stock returns. If we can but recognize that corporate earnings have with remarkable consistency grown at the rate of GDP, we can understand that it is the fundamentals of our economy that drive long-term stock returns.